Today, we're looking at Mastercard, ticker MA, and honestly, this is one of those companies where the quarter itself was very strong, but the stock discussion is a little more complicated, because with Mastercard, the debate usually isn't, is this a good business? It is. The real question is whether you're getting enough return potential when you're paying a premium multiple for a business that everyone already knows is high quality. So in this video, I want to walk through Mastercard's Q1 2026 results, what actually drove the quarter, why value-added services are becoming a bigger part of the story, and then we'll get into the valuation and the 5-year upside scenarios. And before we get into it, if you enjoy these stock breakdowns, make sure to like the video, subscribe to the channel, and drop a comment below with your thoughts on Mastercard. Is this still a buy at this valuation, or is it just too expensive? Alright, let's get into it. Mastercard delivered a very strong Q1. Net revenue came in at $8.4 billion, up 16% reported, or 12% on a currency-neutral basis. Adjusted EPS was $4.60, up 23% reported and 18% currency-neutral. Net income was $3.9 billion compared to $3.3 billion last year. So right away, this was not a weak quarter. But the more useful way to think about Mastercard is to remember what kind of business this actually is. Mastercard is not a bank. It does not lend money in the same way a bank does. It is a global payments network, which means it makes money from transaction volume, cross-border activity, processing, and a growing set of services around things like fraud prevention, authentication, analytics, and consumer engagement. So when I look at a Mastercard quarter, I'm not just looking at revenue and EPS. I'm looking at things like gross dollar volume, purchase volume, switch transactions, cross-border volume, and services growth. And on those metrics, the quarter looked very healthy. Gross dollar volume was up 7%, purchase volume was up 9%, switch transactions were up 9%, cross-border volume grew 13%. That cross-border number is especially important because cross-border activity tends to be one of the most profitable growth drivers for these payment networks. When people travel internationally, shop across borders, or businesses move money globally, Mastercard benefits in a very high-margin way. So when cross-border is growing double digits, that usually makes the overall Mastercard story look much cleaner. The payment network segment itself grew revenue 12% reported or 8% currency neutral that was driven by the same core factors: more volume, more cross-border activity, and more switch transactions. This is the beauty of Mastercard's model. Once the network is already built, incremental transactions can flow through with very strong economics. It does not need to build factories or take on heavy credit risk to grow. It needs more payments moving through the network. And that is exactly what happened this quarter. But the part of the business that I think deserves even more attention is value-added services. Value-added services and solutions revenue grew 22% reported, or 18% currency neutral. That is a big number for a company this large. And this is where Mastercard becomes more interesting than just people swipe cards. Mastercard gets paid. The company is building a larger business around security, digital authentication, fraud tools, data insights, consumer acquisition, engagement, and pricing. These are services that can make Mastercard more deeply embedded with banks, merchants, fintechs, governments, and other partners. In plain English, Mastercard is trying to become more than just a payments toll road. It wants to be a broader payments technology and data platform. That matters for the long-term thesis because basic card volume is already a large and mature market in many places. It can still grow, especially as cash shifts to digital payments. But the services business gives Mastercard another way to expand beyond just transaction growth. And based on this quarter, that side of the business is still growing very well. Margins also moved in the right direction. Adjusted operating margin came in at 60.8%, up from 59.3% last year. GAAP operating margin was 58.4%, up 1.2 percentage points. A 60% operating margin is just an incredible number. There are not many companies that can grow revenue double digits while already operating at that level of profitability. That is one of the main reasons Mastercard trades at a premium valuation. Investors are not just paying for growth, they are paying for growth with extreme profitability, strong cash generation, and a business model that does not require a huge amount of capital to scale. Cash flow was solid too. Operating cash flow was about $3.0 billion, up from $2.38 billion last year. If we subtract property and equipment purchases of $154 million and capitalized software of $181 million, estimated free cash flow was roughly $2.66 billion for the quarter. That is a lot of cash. And Mastercard is returning a lot of it to shareholders. During Q1, the company repurchased 7.8 million shares for $4 billion and paid $777 million in dividends. Then, through April 27th, it bought back another 3.3 million shares for $1.7 billion. So we're talking about $5.7 billion of buybacks between the quarter and the early April update. That is aggressive. The company still had $11.7 billion remaining under approved repurchase programs, and management said the accelerated buybacks reflected current valuation levels and confidence in the long-term growth outlook. Now, I would not take that to mean the stock is suddenly cheap in an obvious way. Mastercard still trades at a premium multiple, but it does suggest management sees the recent pullback as a reasonable use of capital, and the buybacks are having an impact. Diluted shares fell from 914 million to 893 million. That is why EPS growth outpaced net income growth. Net income grew 18% reported, but adjusted EPS grew 23%. The business is growing and the share count is shrinking at the same time. That combination is what makes these mature compounders so powerful over long periods. Now, it was not a perfect update. The main issue is what happened after the quarter, especially in April. In Q1, cross-border volume was up 13%, helped by both travel and non-travel cross-border spending. But management also said cross-border travel began seeing some impact from conflict in the Middle East starting in March. Then in April, the trend softened. Cross-border volume growth slowed to 9% month-to-date through April 28th, and cross-border travel slowed to just 2%. That is a noticeable slowdown. Management did give some context. They said underlying consumer and business spending remained healthy, and some of the April weakness came from holiday timing, portfolio shifts, and geopolitical disruption rather than a full breakdown in demand. Still, I would not just brush this aside. Cross-border is a very important profit driver for Mastercard. If that starts slowing more meaningfully, it can affect both growth and sentiment around the stock. It is not a deal breaker based on what we have right now, but it is definitely something I would watch next quarter. Another positive detail from the quarter was contactless adoption. Contactless reached 78% of all in-person switched purchase transactions, up 5 percentage points year over year. Mastercard also had 3.7 billion Mastercard and Maestro branded cards globally, up 5%. That might sound like a small operational detail, but it supports the broader digital payment story. The easier it is to tap and pay, the more payments move away from cash and into card and digital rails. And for Mastercard, that long-term shift is still one of the biggest secular tailwinds. Now let's talk about the balance sheet. Mastercard ended the quarter with about $7.9 billion in cash and roughly $19.0 billion of short and long-term debt. So net debt is around $11.1 billion. For some companies, that might be a bigger issue. For Mastercard, given the cash generation and earnings power, it looks very manageable. This is still an asset-light, highly profitable business that throws off a lot of cash. The balance sheet does not look like the thing investors should be worried about here. The bigger concern is valuation. At around $502,092 splens per share, Mastercard's market cap is roughly $455 billion. The trailing PA is around 32 times, and the forward PA is in the mid to high 20s. Using the balance sheet, enterprise value is around $466 billion. If we annualize Q1 revenue, that gives us about $33.6 billion of revenue, which means Mastercard is trading at roughly 13.9 times annualized revenue. That is not a bargain bin valuation. And this is where the investment case becomes more balanced. Mastercard absolutely deserves a premium. Revenue is growing double digits, EPS is growing even faster, margins are extremely high, free cash flow conversion is strong, the business is asset light, buybacks are meaningful, and the digital payments runway is still intact. But when you pay around 26 times forward earnings, the company has to keep executing. You are not buying a broken business at a depressed price, you are buying a world-class business at a world-class multiple. So the valuation looks reasonable for a long-term compounder, but not obviously cheap. I would describe it as fairly valued to slightly attractive, assuming you are thinking in terms of a 5-year holding period. The 5-year outlook still looks solid. A reasonable base case is high single-digit to low double-digit annual revenue growth. That would come from digital payment adoption, cross-border normalization, commercial payments, and continued growth in value-added services. Management's updated 2026 outlook calls for revenue growth at the high end of low double digits to low teens on a GAAP basis, with currency-neutral growth excluding acquisitions and dispositions at the high end of low double digits. So the near-term outlook is still strong. Merchants probably do not have unlimited room to expand from here, because Mastercard is already operating at such a high level. The more realistic assumption is stable to slightly higher margins, helped by services growth and operating leverage, but offset by investments, incentives, acquisitions, and regulatory or competitive pressure. For valuation, the base case uses adjusted EPS of about $19.30 for FY 2026, then assumes EPS compounds at 11% annually over 5 years. That gets us to roughly $32.50 of EPS in 2031. If we apply a 26 times exit multiple, that gives an implied 5-year share price of about $845, compared to the current price of $502.92. That is roughly 68% upside, excluding dividends. That is attractive, but not explosive. And the reason it is not explosive is because the starting valuation already gives Mastercard a lot of credit. The business can do very well, and the stock can still produce good but not crazy returns. In the bull case, the numbers get much more interesting. If revenue grows around 12% annually, value-added services continue growing at an 18% plus rate for several years, cross-border remains strong, margins stay near 61% or expand slightly, and buybacks keep reducing the share count, then EPS could compound closer to 14% annually. With a 30 times exit multiple, the projected share price would be around $1,130. That would be about 125% upside from here. That is the version where Mastercard continues proving it deserves to be one of the market's premium global compounders. The bear case is not some dramatic collapse scenario. It is more like this: revenue slows to mid-single digits, cross-border weakens because of macro or geopolitical pressure, regulation puts pressure on fees, and newer payment systems like stablecoins or account-to-account payments create more pricing pressure over time. In that case, EPS might compound at only around 6% annually, and the exit multiple could compress to 20 times. That gets us to a projected share price of about $505, which is basically flat from today, and that is probably the most important thing about the risk here. The bear case is not necessarily that Mastercard becomes a bad business, it is that the business stays good, but the stock goes nowhere because investors paid too much at the starting point. That is the real valuation risk. As for the key risks, regulation is probably the biggest structural one. Mastercard is exposed to rules around interchange, surcharging, privacy, data, AI, anti-money laundering, sanctions, and broader digital payments regulation. Competition is another one. Visa is the closest peer, but there are also wallets, real-time payments, account-to-account systems, stablecoins, and closed-loop ecosystems that could pressure parts of the card network model. Then there's cross-border sensitivity. Because cross-border transactions are so profitable, weaker travel, geopolitical conflict, or tighter currency controls could hurt growth and margins. And merchant pressure is always there. Merchants do not love acceptance costs, and any pressure on fees, incentives, or routing could reduce Mastercard's long-term monetization. So for next quarter, I would mainly watch a few things. First, cross-border volume growth. Was April just a temporary slowdown or the start of a softer trend? Second, cross-border travel. Going from strong Q1 growth to only 2% in April month to date is a meaningful change. Third, value-added services. If that business keeps growing near the high teens, it strengthens the long-term thesis. Fourth, rebates and incentives. If those rise faster than network revenue, it can pressure the quality of revenue growth. And finally, buybacks. Management has accelerated repurchases, so I want to see whether that continues. So, bottom line, Mastercard remains a world-class mature compounder. This was a strong quarter. Revenue grew nicely. EPS grew even faster. Cross-border was strong during the quarter. Value-added services continued scaling. Margins expanded. Cash flow was healthy. Buybacks were aggressive. The long-term thesis looks slightly better because services are becoming a bigger growth driver, and management is also investing in future payment areas like agentic commerce and stablecoin infrastructure. but the stock is not cheap enough for me to call it a screaming bargain. At today's valuation, I would say Mastercard is bullish but valuation aware. The business quality is extremely high, the risk level is medium, the confidence level is medium-high, and the stock is best suited for long-term investors who want a durable compounder rather than a high-risk turnaround. In my view, the base case is still attractive, around 68% upside over 5 years, excluding dividends. The bull case could be much better, with roughly 125% upside. But the bear case reminds us why price matters, because even a great company can deliver flat returns if the multiple compresses. So for me, Mastercard is still one of the highest quality businesses in global payments. It is just not the kind of stock where you can ignore valuation completely. If you believe Mastercard can keep compounding EPS at a low double-digit rate, the 5-year risk-reward looks reasonably attractive after the pullback. But if you need a big margin of safety, this probably still is not cheap enough, and that's my take on Mastercard. If you found this breakdown helpful, make sure to hit the like button, subscribe for more stock analysis videos, and comment below with your view on MA. Would you buy Mastercard here, wait for a better price, or avoid it because of the valuation?